Welcome to the intricate world of global fuel markets and geopolitics. Recently, Russia implemented a temporary export ban on diesel and gasoline, causing a ripple effect in international fuel markets. In this video, we'll examine the ban's details, its impact on European fuel prices, and its broader implications for global energy dynamics. Let's navigate this complex terrain together. In an effort to stabilize its domestic fuel supply, Russia has implemented a temporary ban on diesel and gasoline exports. This move has had the unintended consequence of driving up fuel prices in Europe, which were already under pressure due to global fuel shortages. Russia had been the world's largest seaborne exporter of diesel-type fuel this year, narrowly surpassing the United States, according to data from Vortexic compiled by Bloomberg. From January to mid-September, Russia shipped over 1 million barrels of diesel daily, with Turkey, Brazil, and Saudi Arabia being some of the primary destinations. This export ban, which also encompasses gasoline, went into effect on September 21 and does not have a set-in date. As per a government decree, diesel prices in Europe surged due to concerns that this measure would exacerbate the existing global fuel shortages. The world's oil refineries have been struggling to produce enough diesel, partly due to reduced crude oil supplies from Russia and Saudi Arabia, the largest producers within the Organization of Petroleum Exporting Countries, OPEC, and its allies. Alan Gelder, Vice President of Refining, Chemicals, and Oil Markets at consultancy Wood Mackenzie Ltd., emphasized the significance of this ban, stating, "Despite its temporary nature, this ban will have a substantial impact since Russia plays a crucial role in global diesel exports. The global refining system will face challenges in replacing the lost Russian volumes, especially when global diesel inventories are already at low levels." In Northwest Europe, the premium of benchmark diesel futures over crude oil, known as the ICE gasoil crack, surged significantly, briefly exceeding $37 per barrel, according to Bloomberg's fair value data. Diesel futures for October delivery also became more expensive relative to those for the following month. This bullish market structure, called backwardation, surpassed $35 per ton before easing some of those gains. The Russian government's press office stated that the temporary restrictions were intended to saturate the domestic fuel market and, in turn, reduce prices for consumers within Russia. Exemptions to the ban include minor supplies to trade alliance partners from former Soviet republics, as well as intergovernmental agreements, humanitarian aid, and transit shipments, as stated in the decree. Under the same decree, fuel cargoes that have already been accepted for shipment by Russian railways or have loading papers for seaborne transportation can still be exported. This suggests that diesel exports will only gradually decline as these cargoes are shipped. For instance, the tanker named Elora departed from Russia's Black Sea port of Novorossiysk after loading approximately 35,000 tons of gasoil, according to vessel tracking data monitored by Bloomberg and a port report. The export ban encompasses all types of diesel, including summer, winter, and Arctic blends, as well as heavy distillates like gasoils, as specified in the decree. In the previous year, Russia's seaborne exports of diesel-type fuel amounted to about 0.95 million barrels per day, accounting for approximately 3.4% of total global demand. Eugene Lindell, head of refined products at consultancy FGE, emphasized the significance of this ban, saying, "This is a super big deal. We're talking about shutting in exports of close to 1 million barrels a day." However, he noted that Russia might not be able to sustain this export ban for long, as they could soon run out of tank storage capacity. Russia's government has been engaged in discussions with oil producers for weeks to determine measures to control rising fuel prices. President Vladimir Putin mentioned last week that officials and companies had reached an agreement on future actions, but the negotiations have persisted. According to individuals familiar with the matter, surging fuel prices, particularly for car fuel, have been a major contributor to inflation. posing a potential political challenge as Russia prepares for its presidential election in March. According to data from the Federal Statistics Service, retail gasoline and diesel prices in Russia increased by 9.4% from the beginning of the year to September 18, compared to a 4% rise in overall consumer prices. The sensitivity to rising fuel prices and their impact on farmers came to the forefront when Vyacheslav Volodin, the Speaker of the lower house of parliament, and a key ally of Putin, criticized the Energy Ministry for failing to prevent the price hikes. First Deputy Energy Minister Pavel Sorokin informed lawmakers that the government was considering quite serious measures in response to their concerns,